Hello, welcome to another episode of Daily Market Mastery with me, Christian Rauchenwald. It's been a while since the last time. The last episode was actually on the, what do we have here, 26th. So we had a couple of days in between without a stream. I hope you all had a great time and I hope your portfolios were on the rise. As always in Daily Market Mastery, we use Elliott Wave Theory to try to predict the forecast the movements of specific stocks and indices, to based on that then manage our portfolio, or my portfolio in that case, that people on eToro, since I'm a popular investor, can easily copy. You can find a link to check out my portfolio in the pinned comment in the chat or pinned chat message, and also in the description down below. Now, you can also find links down there in case you don't know to read the Elliott Wave Principle book for free or order a physical copy, and to the one-page cheat sheet that we're using that saves us a lot of headache in identifying Elliott Wave patterns. That said, as usual, disclaimer, everything that I share in this live stream / video, if you're watching it later, is my personal opinion and in no way financial or professional advice of any kind. You should always do your own research, consult certified professionals, draw your own conclusions, and make your own decisions. And with that, we're almost ready to go. I'm just going to start a timer so I don't go over time. So as usual, you guys now you can see it. So timer's running, and gonna enjoy a sip of my coffee and hide the highlighted message, and then we're good to go. Now, we actually had a decent, what started out as a decent month now. What started out as a decent month now got kicked in the teeth during the last couple of days. If we look at the SPX, there we had like a spike up. We're still fine with our labeling, but that spike up that happened here basically caused the portfolio negative end of month performance. Where do we have it? No, that's YouTube. That's here, the tab. 2.5% overall year-to-date performance. Not so great. Still confident that we will turn this around, but it's frustrating to watch things like bank failures after bank failure and like economic trouble and so on, and the market's not reflecting that at all. Because in case you didn't notice, the First Republican Bank now got basically more or less confiscated and sold off to JP Morgan. And there is, I have to look it up, I don't recall exactly the stock name. There is another regional bank, and that would be PacWest Bank Corp. Year to date down 70% so far, 68.92. That's the next one on the chopping block. So, and in terms of absolute amount, the three banks, so what was it, like Silicon Valley, Silvergate, and now First Republican Bank, even adjusted for inflation, the damage in quotes from those three banks that went belly up and had to be sold off or bought up or whatever this year already equals or is slightly more than what what we saw in 2008. And that graph here does not reflect that at all, so far. So patience is the key in investing. Don't know if you've seen the movie The Big Short. So where basically Michael Burry says, okay, I'm not wrong, I might be early, but I'm not wrong. I still believe that I'm right now in that situation, not to that extent, of course. We're not talking about billion-dollar bets against the market or so. We're talking and temporary losses that are like relatively high. We're talking about in comparison to my usual performance, again, like reasonably bad start into the year, and but nothing out of the ordinary so far. We'll see. As said, for me personally, I still believe that things will turn around. It will be sad for the economy, of course, but good for my portfolio. So anyway, as usual, we start off our day by quickly recapping. The SAT SPX, so Standard & Poor's 500, is currently moving against us a little bit. We're still within the actually, let's check real quick so that I don't see anything wrong. What was the come on up here. So high 4,186.92, high 4,148. Okay, we actually would have to relabel, and that would move our 0.2 for now here, which also would force us to adjust the space channel, and we would then need to not like this. So but here we drag it down, that base channel, and which means obviously this is not 1-2 because here we have a new low. I shared earlier in previous episodes already that I wouldn't worry about that, and that we are still within the parameters. As said, like even if we go to 4,260 or 4,325, while it would cause a temporary loss in the portfolio, that would still check out and be fine with me. I'm gonna have like some trouble probably, I don't know, that might then be a combination of a corrective pattern. So instead of having a simple zigzag pattern or something like that, which we may or may not be able to fit into A, B, C here, it might actually turn out to be A, B, C, or actually then W, now how do we label that then? W, X, Y wouldn't check out because that's too small. So W, yeah, W, X, Y, or yeah, not sure about that. That doesn't check out. W, X, how's the other one? W, X, Y, double X. Yeah, W, X, Y, double X. No, W, yeah, Z. Yeah, so in case you're wondering what I'm glancing at our one-page cheat sheet, and I was looking for this pattern, but I somehow kept looking at this one instead. So although a triple three is in wave position number 2, unheard of, but what do we have here? Not unheard of, but triple zigzag. Yeah, there is a chance for a triple zigzag, so still same labeling. So W, X, Y, X, X, Z. Question is if we can label, switching back, sometimes forget switching the screens. So question is if we can label it like this. Yeah, but so overall, yeah, still confident that we'll see new lows. And the point I would start to worry about, just to share it already, is like if we go past the 4,300 mark. So that would be the point where I would be wondering if we screwed up here. But we'll cross the bridge if we get there, not when, but if we get there. So NDX, same situation. So also that spike up caused our month of April to go from positive to a minus 2.5%. Again, still not too big a loss for a single month, but annoying. And then moving on, Shopify, how we're doing there. They're like, let's zoom in a little bit, and I think there we're still doing good. Let's check actually real quick the portfolio. So our Shopify positions are actually still in the green. Yeah, we see Ford Black Knight is not in the green anymore. So Black Knight we have here, but so we'll see if we turn out to be right. That's still fine that we go further down here. Let's really check, or let's check real quick. If we assume this is wave 2 ending here, then we would have our retracement like this. And yeah, we're getting in an uncomfortable range where it's possible that we hit our stop loss. We still have like a little bit more than 10%. No, our stop loss at 52, so 5% wiggle room here. Again, with a huge upside. Possible that we hit a stop loss here and that this one turns out as one thing I labeled wrong. Nobody gets it always right. I also don't always get it right, so perfectly fine if that happens. Not sure what happened here. That should probably look like this, but we don't need that small pattern here, so there we go. And yeah, we'll just have to wait and see how that plays out. I don't want to make any adjustments based on like those movements right now. If I'm wrong here, happens, and then it's just one of the cases. The issue is not about being right all the time. The issue is, or the requirement is not being right all the time. The requirement is either if your trades always have a 1-to-1 risk-reward ratio. So when you lose, for example, let's say $10, and when you win $10, then that you're right more than 50% of the time. Or if you pick trades where your risk-reward ratio is hugely in your favor, so if you lose $10, but if you win $100 or $1,000, then that you simply have the occasional win that's big enough to outweigh all the losses that you made. So whatever trading, by the way, no matter if you use Elliott Wave Theory or if you use any other trading strategy, none of them offer you 100% guarantees. In my opinion, Elliott Wave Theory is the most accurate one out there. Again, just my personal opinion, and mastering it, which is one of the goals why I'm doing those streams, even so that I have accountability, that somebody can say, hey, what you labeled there on the chart is complete garbage because of this and this rule that you didn't consider. So is in my opinion the best way to have consistent results. Anyway, moving on. Ford we're actually expecting that, okay, there we have a new low, a little bit lower here, but our Ford position should still be live. So Ford, but it's slightly at a loss. And again, there we we labeled it actually like this, that we say, okay, we have this long 1, 2, and now we are basically in the beginning of wave 3, which separates again into 1, 2, and where this here would turn out into a WXY. Yeah, we'll see if that turns out like this, because for it to be the case, we would need to see now here, we have a little bit wiggle room to go a little bit more sideways or so, but eventually we would need to see the breakout to the top. If there is no breakout to the top, well, then we will eventually hit our stop loss and move on from this. In terms of retracement, let's quickly check if we're there within the ranges that we are expecting or comfortable with, or however you want to call it. So yeah, we actually, like we barely touched the 50% one. So yeah, like so. We would usually, but we obviously we touched the 38.2. So actually that would be the range in general. So 38.2, 68.1, in that range, we would expect the turnaround to happen. So it's not that it's not, it's not that it's perfectly turning around on one of those lines. So, but we are within the range where it would be expecting, not guaranteed, but where it's like, okay, it's possible that it will turn around here with a reasonable, I don't know, certainty, however the right word is, but it's also possible that it would turn around here. And obviously there are cases where, since it's not stone set rules in some cases, but like more like, kind of say like probabilities, it's very likely that it happens in this range, but it's also possible that sometimes or in some cases it doesn't happen in the range, it goes further or it doesn't go that far. But so far we're good there. GameStop, again, just check the GameStop episode if you want to know about all this here. Domo, we already made a profit, in case you remember. So we actually looked at it from the long-term perspective. We can see that here's a big 2 and we're waiting for the big 3 and we're talking about multi-year outlook. Then we bothered to label that smaller pattern here. And again, we might be wrong with that smaller pattern, but then we noticed, hey, we actually got in around here, which was super, it was lucky that on that day, around that time, we actually reviewed it. And then around here, I noticed during my review again, hey, it looks like this is another 1, 2, 3, 4, 5 pattern. So an impulse wave finished with the corrective pattern now playing out. And where we're saying, okay, so if that plays out like this, we would have, we would expect there's the highest point or not, like check. So that's high 1626 and that's high 1630. We would expect now, so we sold them somewhere here with an average of 15% return on our position here. From that in quotes wave 5, and where we're saying, okay, then this will play out probably as an ABC, where we have a little bit more upside. We looked at it, I think, then, so we sold here and then looked at it again. I don't know if we looked at it again here or not. Like where was that date 26th, 26. So we looked at it again here. So expecting potentially a little bit more upside here and waiting for it to go down. And we have a couple of indicators that point towards our target being around $13.60. So if we look here, we have wave 4 of the, corrective wave here, not always, but often declines or retraces whatever into the area of wave 4 of the previous impulse wave of a lower degree, which would be this one, 37.3. Then we have our guideline, whatever your rule of thumb, however you want to call it, that makes us expect, okay, that we would see a turnaround or a potential correction would go like 61.8, 38.2, 50%, where we have the 61.8 at 13.6 exactly. And then the third thing, which we now have to double check, is that if this is a zigzag, then very often if we take a regular trend line, where do we have trend line, and use it to connect the starting point here for point A, and assuming that this now is point B, very often point wave C will follow or will be identical, in quotes, identical, so with wave A, which means that it points towards 30.77. So we have 30.77, 30.6, and 30.73. So 3 different, not rules that are set in stone, but guidelines that all say, hey, that's where it has to go before we then go further up. So that's why I have an alert around 30.7 for Domo set, where we would then re-enter the market, so that we basically missed out this entire or most of this downwards movement from, we sold at 16 point something. So like not all the way to the top here, but close enough. So really a nice ride. and yeah, and we'll re-enter here. Or it's also possible that this is wrong. We go further up here, and then basically, yeah, we'll have to re-enter higher and missed out on some profit. Although it also helped to reduce the perceived temporarily unrealized or non-realized loss of the portfolio for April, because we didn't suffer that downturn here. And yeah, and then we have SQ, which is Block Inc. I mistakenly in the episode kept mentioning it as Square, where we did not open a position there, or did we? Like, no, we don't have a Block Inc. position, and we don't have one because we're waiting how this plays out. And right now we would actually say, okay, it's potentially could be like this, 1, 2, 3, 4, and we're right now waiting for the corrective pattern to play out, which could also. Yeah, and with again using the similar rules, so that one doesn't make sense. Okay, we use that one actually to check, because very often, or not very often, but if we look into the book in the chapter about, I'm gonna share the book screen in a second, in the chapter about ratio analysis, which is, what was it, page 150, if I'm not mistaken, somewhere in that area, long-term waves. So 153, one blah 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 blah. Okay, 130, 130. Those are those. Yeah, 137. No. Yeah, can't find it right now from the top of my head, but we expect, don't quote me on that right now, as I can't find the exact page right now, but if I recall it correctly, we're waiting for a retracement to the 50% line here, so from A, B, and that's why we have the B spot exactly, or in that range here at 149, no, like 120 should be. So actually here we have it at 61.8. Maybe that's what the book says, 61.8. Those numbers appear very, very often in like ratio analysis in general. So 38.2, 50, 61.8. And so we're actually thinking, okay, it might turn out to be here first and then go down first, and then we would wait for that. Yeah. Anyway, now I probably will in the future switch to weekly recaps or so, because we already are 60 minutes in the stream and we haven't looked at anything new. So let's try if we can. And yeah, I'm for sure writing it wrong. Yeah, no, Icahn. So yeah, so I'm not sure if you noticed, Hindenburg Research published a piece about Icahn Enterprises, stating that it's super inflated. It already takes a hit. And obviously, I mean, we might be too late to the party, but we're going to look at IEP. I'll quickly check if I can actually invest in IEP. Yes, I could. So I could also short it potentially, which means we're going to take a look here at, yeah, we need a new analysis. Oh, no, not an alternative analysis. We need a new tab here. So that's new chart. And we need to find IEP and IEP in US dollars. And there we go. And then the first thing we always do, because as you know, I'm using Motive Wave here. By the way, all the tools that I'm using are linked in the description down below. And the first thing we do is we also open it up on on TradingView. Why do we do that? We do that to make sure that the data source, since I'm using Interactive Broker as my data source, has the full data. Yeah. So, oh yeah, that looks like it. Yeah. Yep. Nice. So, and here we have data from 1987, and we here have data, if we are on the monthly chart from, will take a moment to load. Okay, we don't have it from 1987, which makes it impossible for us to label here, yeah? Which is a big point. Always make sure your data source works out. I've even seen like Jeffrey Kennedy from Elliott Wave International publish once, yeah, completely... Yeah, not completely wrong, but based on his data correct, but actually completely wrong analysis for GameStop, because his data source didn't adjust for a stock split at some point or so, which caused him to label a pattern that was actually invalid, so using the right data, yeah? And therefore, if that happens in your analysis, you suddenly end up risking money because what you believe is the full history and that's the pattern, then is not, yeah? Now, yeah, if we look at the bigger picture, I might actually end up, so we're not going to label this here because we lack the data. And although we might still be able to label this, 2014 was the high here, and here the all-time high was that. So we actually are looking at this part down here, which is okay. So let's first label this here, and we're going to just use Kennedy's channeling technique. And I'm just going to throw some labels there, and then we're going to work out if they're correct with Kennedy channeling technique. So I'm just going to throw this here like this, yeah. Now, if you recall Kennedy's channeling technique, we start off with a so-called base channel, and the base channel connects the point 0 with point 2 and goes through point 1. Yeah. Now, we would need to also work out if that is actually a wave 1. Yeah. The starting point might be here potentially. Yeah. So like we would need to do that if we were looking at that part, but all we care about is like if we end up here on wave 5. Now, in that base channel, we usually expect a breakout from the base channel. It actually might work out better because we might not be able to 1, 2, 3, 4, 5. Yeah, like, well, let's leave it like that. So, but we basically, once we have a base channel, we wait for a breakout from the base channel to confirm that we're in a third wave movement. Now, if we were still doing the movement, then we would basically connect, so it's our so-called acceleration channel. We would basically connect point 2 with whatever, we would connect point 1, I clearly need more coffee today, point 1 with whatever new high we have, with a parallel through point 2. Yeah, it's a little bit tricky finding the right point here. So, and we will wait for a breakout to the bottom to indicate that we're in wave 4. Now, I picked this high here, so assume anything after this doesn't exist, and we are like, okay, now we're in the third wave. When we're already maybe too late to the party. I mean, we don't know for sure, but whenever there's a breakout to the bottom of this channel, we definitely should be in the fourth wave. And therefore, we're waiting for that, because when we're in the fourth wave, we might be able to short it, or we can then at least wait for the confirmed fifth wave to at least write that, yeah? Now, yeah, that's not the case here, so we don't have a breakout, so we have the next high develop, the next high develop, and again, we have to eventually adjust, so we need point 1, high point, parallel through point 2. Yeah, now if we were to get close here to the breakout already, then we would need to adjust to make sure that we're here on point 2 again. But nothing happened so far until we basically reach this high here. And then now I'm going to adjust this to, again, reflect point 2. So roughly here. And yeah, so now we see we have a breakout from our acceleration channel. So which indicates, hey, we are now in the fourth wave movement. And as you know, Kennedy channeling technique says not always, but frequently enough, wave 4 will touch the top or the median of the base channel, and surprisingly enough, it apparently does that. It even goes a little bit further than the median. So again, because it doesn't do it always and in any time and whatnot, it would have been a decent opportunity or like, yeah, like, I mean, there's risk involved and so on, but potentially we could have shorted. Yeah? Now, next thing, if we're in wave 4, we need a so-called deceleration channel where we take our point 3, and whatever high we have, we basically, it's a little bit, yeah, it's not, again, it's that's like, Kennedy channeling technique is kind of like an aid to help with Elliott Wave Theory. It's not a guaranteed tool that always works and gets it right. But we basically would put the line on high points, and when we have a breakout from that channel, that gets confirmed. So when we have a breakout from that channel, so then basically we assume that we're in fifth wave territory. So again, no trading strategy is always perfect and 100% correct. And sometimes you will get it wrong, because here, for example, we would have a breakout. We might already say, yay, now we're in fifth wave, let's go here and open our trade. However, then our stop loss would be here at 18, and we would have entered around, I don't know, 37. So we would have a 50% loss risk for our position. we obviously would never throw our entire portfolio into one position. So overall, we would probably look at a 5% risk, or no less. So if we take 1 to 2% of our portfolio, we would look at actually 0.5 to 1% risk for the portfolio with a very, very decent upside. Now here that turns out wrong. So this is not wave 4. And we actually figure out that then this would be the point that we were looking for, which we wouldn't have found in this case with Kennedy channeling technique. Yeah, so here Kennedy channeling technique would have failed us a little bit, but doesn't matter. We now know that our wave 4 would be this low point if this is actually an accurate data point. If not, it would be this one. Yeah. And then we need our destination channel. Let's see how that checks out, which also might help. Let's see. So where we take 0.2, 0.4, and a parallel through 0.3, and then very often wave 5 will touch the median or the top of that so-called destination channel, and it's really nice because it shoots a little bit over the top here and then starts to decline, which makes this a reasonable assumption. So this is 1, 2, 3, 4, 5, and then from here we go down. Yeah, that's now a wave 2. Now, which brings us in a very interesting situation. Unfortunately, the Fibonacci retracements on TradingView are, I don't know, not to my liking. I mean, let's see if it works here a little bit up, but yeah, like I always feel like either have them configured wrong or the percentages are just off, or there's a different understanding of how they are calculated here. It just always feels to me that they, on a bigger scale, seem to be off. Yeah. But technically, as said, not a rule, but a guideline. That wave 2 would retrace into the area of wave 4, which would be at least the $20 range. So which would mean for that wave 2, which could, by the way, be 1, 2, 3, 4. Yeah, and that 5 cannot have finished because then it would need to be 2, 1, 2, and then we would be in wave 3 with the biggest decline. Yeah, so that wave 2 would actually need to go down to basically the $10 mark per share again. Yeah, so like anywhere from 20 to 10. Again, depending on if this here is a fluke. I don't think it's a fluke. So like by fluke, I'm meaning that TradingView has some wrong data here, that it actually didn't go down like that, which for a month would be an incredible effect from 50 down to 10 and basically back up. But yeah, who knows? So like, I mean, obviously we could bother other sources to check that, but even without that, it should go to the $20 mark. Now, I'm not sure. I'm going to actually check on my other screen. What would be our risk? Yeah, it's like IEP. If we short that thing, cannot even short it. Like, are you? Huh. Oh, it cannot be shorted. How convenient. Yeah. So there. So at least on eToro, it cannot be shorted, which is really, really convenient. Yeah. So I can only buy, which I wouldn't do. Not just because of our analysis, but basically because of the analysis that Hindenburg Research actually published about, Icahn enterprises. Why can I not short it? Yeah, it's like really like not a fan when I see that things are restricted in some way. So clearly somebody is able to short it. Hindenburg Research has their short position, so it's only on eToro and potentially other brokers that it's currently not working. Yes, I could check an interactive broker and probably would be able to short it there, but I don't like to manage positions across too many accounts. In case you're wondering, so like for things where I'm long-term investing, like for example GameStop, super bullish on that one, I hold the shares directly registered in book form at their transfer agent, which is ComputerShare, and whatever I'm like basically just like trading, so trying to catch the upwards movements or downwards movements, I'm just doing in eToro because it's convenient. Yeah, I know there are downsides to it and whatnot. Yeah, like especially if you get a chance to read Naked, Short, and Greedy by Dr. Susan Trimbath, then you will understand those downsides. But the convenient and feeless structure wins out here. Yeah, it's a pity now because we're not able to short it as said. So, but we'll I will label this episode as IEP review, and I will mark it in my Google spreadsheet, and we'll see how it develops. But basically, again, assuming that this is not a data fluke on the chart, I would expect it to go down to $10, which might be really, really awkward for Icahn Enterprises, considering that they have like 5 billion dApps, and according to Hindenburg Research, are already reporting overinflated values for their assets and partially listing assets and counting them that don't exist anymore. So might actually go further. So it might be, all the way down. But based on Elliott Wave Theory, which again is based on mass psychology and therefore applies better to indices than to individual stocks. But based on Elliott Wave Theory, I would expect it to go down much, much further. Yeah. If this here would be a data fluke and our 0.4 would then be here, for example, it might look nicer because then this would be like 1, 2, 3, 4, 5. Yeah, so that would subdivide a little better. Whereas this here looks like 1, 2, and then 3, 4, 5. So the pattern here would look nicer. Either way, with the difference being that then we wouldn't hit that base channel, which, by the way, in case you don't recall, it's like we have the not guideline tip, whatever, but we have the point where we are okay. The fourth wave will reasonably often touch the top or the median of the base channel. But if it doesn't do that, then it will reasonably often touch the top or the medium of if you duplicate the channel on top. Yeah, I mean, that's something I wouldn't use to make my trading decisions. So I would probably rather make my entry orders based on the base channel. And if it goes down and starts to turn around, and then I get the confirmation that we're in a fifth wave and I haven't hit that base channel, then I'll enter here. Yeah, happens. Instead of having my orders somewhere where I actually tend to believe that we will go a decent bit further down first. Yeah. So anyway, we are now at the 30-minute mark. So with that, we bring today's episode to an end. I wish, maybe it's for the good, like shorting individual companies can go very bad, very, very fast because, well, you have limited profit. So if I short it, for example, from 40 to 20, I can make 50% profit, but I have an infinite loss risk because the stock could go up infinitely, theoretically. Even just temporarily to basically hit your stop loss or wipe out your account. So overall, I think it's a pity that we cannot invest, but on the other hand, who knows what it's good for, and we'll just have to wait and see how this one plays out. And if the hit piece, it's obviously Hindenburg Research has an impact on the market when they publish a piece that in quotes exposes or shares their view that is fact-based based on the facts that they present, then you usually get to see something like this. Although, the stock already saw things like this happen in the past. That was obviously during COVID. And there we have the real estate bubble crash of 2008 happening. Yeah. So we'll see how that goes. As a result, however, there should also be, where do we have the SPX? Yeah. So we also see it going down today. Let's see if that marks the beginning, especially in combination with First Republican Bank playing out and other banks losing a lot. If that actually marks the turnaround point for our positions here and finally then gets us on the journey down here. Either way, so switching back. Thank you all for tuning in. Don't forget, you can always check out my portfolio by following the link in the pinned comment or pinned chat message or the description down below. And then see you all tomorrow with another episode of Daily Market Mastery. Till then, bye-bye.